Hi, this is Mike Andrade for BreakingCall.com. This is being recorded on Thursday morning, May 15, around 9 a.m. Pacific Time. Mr. Market can't seem to make up his mind what the next significant directional move will be, and the market has been essentially churning without much sustained progress for the last few months. The big question in our view remains whether equities can correct through rotating sell-offs through the various overbought sectors without driving broader indexes down across the board. That remains an open question that may take a few more weeks to gain better insight. Let's quickly revisit our seasonality forecast, our mass pressure chart. This is a composite of all the years ending in 4 back to 1884. This forecast suggests downward pressure into June, and until new highs are made, we still have the potential for a top. One issue with this method is that although it is quite accurate with time windows to focus on, the direction of the market can sometimes invert, meaning in this case that the important June time frame could still turn out to be a high. The trend is really rather unclear, with some downside bias over the last several weeks. Positive money flow divergences are now outnumbering negatives by about 5 to 1, and this ratio has strengthened over the last couple of weeks, suggesting the potential for at least another rally attempt or maybe a topside blow-off in coming weeks. Let's go through the weekly charts quickly, starting with SPY. Not much has changed here or on the next chart we'll show, which is the QQQ. They have both faltered at price and time resistance, with technology in particular under heavy pressure. The direction of the next range breakout remains critical. Next, let's take a look at the Russell 2000 weekly, which has been showing negative divergence and, as we can see from the chart, is up against resistance at 2 major prior highs. This situation requires vigilance. Let's look at the daily chart next of the QQQ, which may be the key to stocks being able to hold support. If tech can't hold, I think we're going to be in trouble here. This has a topping formation and indications that recent lows could be retested. Critical near-term support is at about 83.25, which is the confluence of trend line, Fibonacci support, and the recent lows. A break of that level could change the intermediate term trend to down. Let's switch now to one of the sectors that has been showing up repeatedly in negative money flow scans, namely semiconductors. I'm showing a monthly chart of the SOXX, which is a Philly semiconductor ETF. This shows us very important resistance in the $79 to $85 range that may be difficult to overcome on the first visit. This market is difficult to read, and higher volatility in either direction may be expected in coming weeks. We still believe caution is advised on the long side, particularly with new positions. Thanks for watching, and visit us often at BreakingCall.com.